Hey everyone, and welcome back to The Explainer. So today we are unpacking a story that literally came so far out of left field it absolutely blindsided Wall Street, retail investors, and honestly, the entire gaming community. We are talking about the completely bizarre, unprecedented news that the video game retailer GameStop has actually launched a hostile takeover proposal for the e-commerce giant eBay. It's a massive $55.5 billion bid that has left financial analysts scratching their heads and internet message boards in an absolute frenzy. We're going to break down the math, the overall strategy, some seriously awkward television interviews, and of course, what this could mean for us, the everyday consumers.
Okay, let's dive into this by looking at the sheer scale of what's being proposed here. This is a massive financial mismatch. At the time of the proposal, GameStop's market valuation was sitting right around $12 billion. Compare that to eBay, which boasts a market capitalization of $46 billion. GameStop is proposing to buy a company that is essentially 4 times its own size. In the corporate world, you just do not see this happen very often.
Which leads us directly to the investigative hook of our explainer today and the exact question that is completely puzzling Wall Street right now. How exactly does David buy Goliath? How can a company with a fraction of the market value afford to swallow a massive, established tech enterprise like eBay? It's a wild, shoot-your-shot deal, kind of reminiscent of times when smaller players like Time Warner Cable or Anheuser-Busch became targets of less valuable players, but the mechanics of actually getting it done are incredibly complex.
Section 1. The Missing Math. Financing a $55.5 billion acquisition.
So let's break down this math. GameStop's proposal offers $125 a share, but there is a major problem. GameStop plans to use about $9.4 billion in cash they have on hand, plus a tentative $20 billion in potential debt financing they've got lined up from TD Securities. Even if you add GameStop's entire market capitalization to those figures, you get around $40 billion. But the proposal is for $55.5 billion. That leaves a glaring $15 to $16 billion hole. In corporate finance, you don't just misplace $15 billion, right? And this glaring mathematical gap quickly became the center of a major media moment.
Section 2. The Awkward Interview. Ryan Cohen on CNBC's Squawk Box.
You see, GameStop CEO Ryan Cohen went on live national television to address this massive proposal, which led to a highly contentious exchange. CNBC anchors Andrew Ross Sorkin and Becky Quick pressed Cohen directly on the elephant in the room. Becky Quick pointedly asked the exact question on every investor's mind: where is the rest of the money coming from? It was a heated back and forth, which is highly uncommon for standard financial news, as the anchors really tried to get clarity on that $16 billion mathematical gap we just discussed.
And Cohen's response? Well, it was totally evasive. When pressed repeatedly on how GameStop could actually afford the deal, he simply replied, "I don't understand your question," and then coyly stated, "We will see what happens." He skirted the direct inquiries completely, repeatedly directing the anchors and the viewers to just go read the details on the company's website rather than explaining the math live on air.
So how did Cohen actually defend the maneuver? Well, he stated that because they're offering half cash and half stock, GameStop has the ability to simply issue more stock in order to get the deal done. Furthermore, he made it clear that if eBay's board of directors rejects the unsolicited bid, he's threatening to take the offer directly to shareholders in a proxy fight. But as you might guess, the market's reaction to this interview was swift and severe. Following the broadcast, GameStop's stock price dropped by 10%. The complete lack of clear answers regarding the financing seemed to really cause investor confidence to waver, suggesting that Wall Street is highly skeptical that this deal will ever actually close.
All right, Section 3. Synergies versus Skepticism. Exploring the business logic.
Now, what's really interesting about this slide is what happens when you objectively examine why GameStop wants this merger. It reveals a fascinating financial narrative. GameStop's standalone revenue has declined for 4 consecutive fiscal years, seeing double-digit drops. But merging with eBay, a highly profitable enterprise with consistent top-line growth, completely masks GameStop's declining revenue. On a pro forma basis, a combined company actually shows positive growth by 2025. It acts as a massive financial lifeboat for the physical video game retailer.
GameStop has also outlined a very specific strategy for how they plan to run eBay if this acquisition is successful. They claim eBay is an under-earning business with a lot of fat to cut. Their proposal states they were going to cut $2 billion in annual costs within 12 months, heavily targeting what they call eBay's bloated $2.4 billion sales and marketing budget. And perhaps most intriguingly, Cohen wants to leverage GameStop's roughly 1,600 physical U.S. retail stores, turning them into a national network for eBay logistics, product intake, and item authentication.
But Wall Street remains highly skeptical. Analysts at Bernstein push back hard on GameStop's narrative, noting that eBay's current CEO has already been executing a really solid turnaround strategy. They pointed out that eBay has been successfully leaning into focus categories like collectibles and used luxury goods, and they even recently acquired the clothing app Depop. Their overarching sentiment is perfectly summarized in this quote: "Why disrupt things? The turnaround is working."
Section 4. The Collector's Nightmare, the Downstream Consumer Impact.
You know, corporate takeovers don't just affect stock prices and billionaire CEOs, they impact everyday people like us. And the gaming media and community are watching this extremely closely. eBay is an absolute giant in the secondhand market. It's literally the primary place where people buy and sell retro video games, consoles, and trading cards. On top of that, eBay already owns TCG Player, which is the largest secondary market for trading cards on the entire web.
So the core fear among hobbyists right now is that if GameStop successfully acquires eBay, they would have a near-complete monopoly over the secondary markets for video games and collectibles. Gaming outlets have highlighted deep concerns that giving one company this much control could cause massive ripple effects on the pricing of items like Pokémon and Magic the Gathering cards. There's a genuine fear that corporate restructuring, or frankly just the massive debt taken on to fund this deal, could eventually lead to the destruction of the key independent storefronts that collectors absolutely rely on.
So we end up here. GameStop, a company that roared to relevance as the ultimate meme stock, is now attempting to use its war chest to swallow an e-commerce giant 4 times its size. If Ryan Cohen can somehow find the missing billions, clear the massive regulatory hurdles, and win over shareholders, this David versus Goliath acquisition won't just reshape Wall Street, it will completely alter how millions of people buy, sell, and collect on the web. Will this meme stock maneuver change the internet forever? It's a fascinating situation, and we will definitely be watching closely to see what happens next. Thank you so much for joining me for this explainer, and keep learning.